Hi, very, very good afternoon to all of you. Um, whoever wants to come up in front, do feel free to come up. I'm Cicely George, the Executive Director of TIE Dubai, and it is my absolute pleasure to have each of you today. Familiar faces, new faces, it's always great to have people returning. I am of the belief that learning what not to do is more important than knowing what to do. Because even in life, you'll figure out what to do, but if you've learned what not to do, is a bigger lesson, I think. So I think you will find today's session very valuable because you should not you can fall down and you can pick yourself up, but you don't crash, right? Because then you've ended the journey. So if you actually pick out the red flags and learn what not to do, it can really equip you in your conversations with the various types of investors that you have. And I don't know, Sion, if you want to do a raise of hands later on who all are in a fundraise journey. But I will very quickly do an introduction to TIE Dubai. TIE Dubai has been around the region for over 21 years, been talking entrepreneurship for that long. We started as a conversation in Silicon Valley back in 1992, and today we are 63 chapters in over 12 countries. We serve the community of founders, startups. Fostering entrepreneurship is really the underlying theory. We work on 5 main pillars: mentoring, networking, education, funding, and incubation. While TIE has a global reach, we work completely with the regional ecosystem. We run programs, great programs. We have a mentorship program. We will be launching one in the next week and a half. So do keep your eyes and ears out. Follow us on TIE Dubai on social media. Everywhere we are TIE Dubai. LinkedIn, Instagram, Facebook, X, YouTube, etc. So when it gets launched, the best way is to actually keep your eyes out and apply from there. And once you register for events, you'll get into a database and you'll get an email as well. So this is an extremely valuable program for companies that are looking for support from seasoned and successful entrepreneurs who will actually help you navigate your startup journey better. The mentorship batches are in cohorts, so keep your eyes open for the next one. We also have the TIE Women MENA program, if that slide can be popped up. If you're a women entrepreneur or if you know women entrepreneurs, do spread the word. The applications are being taken in now. It's running in its 5th year. It's an amazing program, runs all across the MENA region. We work on running 5 separate pitch competitions across 5 regions: Egypt, Saudi, UAE, there's an Emirati focus track, and the rest of the Middle East as well. The finals usually happens at GITEX. There's some prize grant money that's accessible, and there's also a global platform that you get to access to. This year it's in Bangalore, in the TIE Global Summit. Last year was Singapore. Each year it changes. And it's a great platform to network, open your connections, meet potential investors, and really have that global conversation. So do make sure you apply. There's a QR code, and there's also a banner outside if you are not able to do that now. There's a deadline of June 20. Yeah. And then we also have the TIE U-MENA program where we work with the youth and university students. We just completed that. We had our winner fly to Silicon Valley for the finals and pitch in person. So again, remember, so while we have the regional benefit, we also give the global access. TIE Dubai is the Middle East chapter, and in DIC for the last 21 odd years. The easiest way, like I said, is to really follow us look for TIE Dubai everywhere on our social channels. A very special thank you to all our charter members who are the backbone of the organization, to all the board members who make the amazing things in the chapter happen. Thank you to DIC, and all the supporting partners that keep the TIE Dubai chapter moving forward. Skyline University, Paramount Computers, Ask Pankaj, and In5 is like family for us. Before I hand over, I want to quickly mention that we'll keep it interactive, the sessions. There's an overall division of 3 sections. So after each of the sections, we'll open out for a bit of Q&A and then keep most of the questions at the end. Because otherwise, usually what happens is a lot of questions come and then the whole session gets delayed. But we want to have your questions, want to make sure that your queries are answered. And before I get in, I would love to introduce you to Sion of Plug and Play. She leads the ventures and investment activities at Plug and Play Abu Dhabi, from direct investments in early stage startups to technology sourcing for corporate and government partners. Sion has interfaced with entities across the fintech, health tech industry for verticals. She leads Plug Play's investment into Seba Health, Velex, and hopes to build a thriving ecosystem for startups of all stages. Outside of Sion's day-to-day work, she's a mentor for the Zayed University Partner Challenge program, as well as an advocate and advisor to female founders through the Women in VC Network and Plug and Play's Found Her initiative. Thank you, Sion, for taking out your time, and I hand it over to you.
Thank you so much, Cicely, for that introduction. I've had the chance to meet a couple of you already, so I'm super excited to get this session started. First of all, before we get started, I want to know who's actually in the room. So if you're a founder or an entrepreneur, can you raise your hand? Okay, I think that's majority, like 99% of you. And for those who didn't raise their hand, can I ask who else is in the room? No? I saw a few unraised hands, so I don't know, maybe it's a secret what you guys are doing here. But today we're going to go through kind of investor red flags. We're going to look at this actually from two different ways. So if you are a startup looking to raise funds, you want to know, what are the investors looking out for when you're presenting to them in terms of red flags? What's making them concerned? Why don't they want to write that check? Why don't they want to sign today? So that's one side of the red flags we're going to be looking at. The other side is, if you are an entrepreneur raising funds, you should also be thinking about how selective you are going to be with what money you're taking in. Are you going to take anyone's money, or is there certain value that you're looking for when you're speaking to an investor? What red flags should you be looking out from them? So those are the two kinds of red flags we're going to be looking at today. Cicely did an amazing job introducing me, but I'm just going to do it again myself as well. So I'm Sion. I do lead the ventures and investment team at Plug and Play in Abu Dhabi. I've been with Plug and Play for the past 3 to 4 years now, and led 4 of our investments, mostly in the health and biotech space. I also interface a lot with our corporate and government clients in helping them with their innovation activities as well. So at Plug and Play, I think Cicely was saying that Ty actually started off in Silicon Valley. Plug and Play is the same. We started off in Silicon Valley, and there are 3 main things that we do. So we do invest in early stage startups from pre-seed up until pre-series A. And we are industry agnostic, so we will invest in, health tech, fintech, insurtech, anything else in between, as long as there is a focus on technology. And we do also specialize in B2B SaaS as well. So if you are a business selling to another business, a software, that is usually what our bread and butter is. We do something called corporate innovation. This might be a new thing to some of you, but essentially a lot of corporates, to stay competitive in their industries, they also want to have an innovation team, and they want to have the most innovative solutions as well. So we help to connect corporates with basically startups so that they can have their solution as part of their business offering. And so you can think of us as a matchmaker between corporate and government and the startup ecosystem. And the third thing that we do is we run accelerator and incubator programs on behalf of these corporate and government partners that we work with. You might know maybe a few of the names that we work with right now. We're working with ADCB, we're working with Emirates NBD on the fintech side, and then on the health side, we're working with Cigna Health Insurance. We're also working with, I'm drawing a blank here, Neom Health and Wellbeing, and also Pfizer in Saudi as well. So that's just some of the examples of partners that we work with. And And yeah, going back to the story of how we started, it was actually a real estate play at Plug and Play. Much like In5, we had a co-working space. Saeed Amidi, who's the founder and CEO of Plug and Play, is the one on the phone in the bottom row. And essentially, you know, he was like, I have this building in Silicon Valley, what should I do with it? And he starts enlisting all of these young founders building their Silicon Valley dreams. And he said, I'm not going to take rent from you, I'm going to take equity from your company. And they said, okay, we're broke, so you can take equity from our company and we won't pay you rent. And that's how we got kind of involved in a lot of the early Silicon Valley unicorns. So Google, PayPal, Dropbox, they're all part of our portfolio. I'm going to zoom through this first part because it's not talking about red flags, but we do have an entire ecosystem of stakeholders that we work with. Over 50 locations around the world, including in MENA, we're in Abu Dhabi, we're in Riyadh, we're also in Morocco and Egypt as well. And these are some of the corporates that I mentioned that we work with. And these are the verticals that we have programs in around the world. And these are, you know, I mentioned that we are a venture capital firm as well. So we've invested in over 2,000 companies since 2006. Very fortunate to have 30 of those be unicorns. And our average ticket size is $100,000. I think last year we made around 180 investments around the world. And like I said, we usually invest quite early from pre-seed to pre-series A. Okay, here's the real meat of the presentation. What are red flags? Some of you have already taken a photo of that slide, so can anyone tell me, maybe from your experience, what a red flag is? Maybe you've had relationship red flags come up. Anyone know what a red flag is? Yes, Atul? Yeah, a red flag might be doing something you're not really meant to be doing. But I would say a red flag is a warning sign for potential risk ahead, or something dangerous is coming up. You know, you might put a red flag up and say, oh, like this is a red card, you know, don't do it again. But what do you think is the difference between a red flag and maybe like a red light at a traffic, you know, intersection? What is the difference between these two things? Exactly, yeah. So I think a red light at a traffic intersection, you have to stop what you're doing, you know, don't make the investment or don't choose this investor. But a red flag isn't really a stop sign. It's saying, okay, there is a risk here, but maybe we can still make the investment. But the thing is, if I'm looking at a company, I'm looking at an investment opportunity, and there's 20, 30 red flags that are coming up, maybe that's an indication to not make that investment, right? Or to not choose that investor for your startup. So a red flag is there to warn you of the dangers ahead, but it's not really, like, it's not a deal breaker is what I will say. And there are ways in which you can explain certain red flags to investors even before they're concerned about it. And so today we're going to go through some of those. I'm going to pause here for any questions. No? Okay, perfect. So, what are some red flags that I could spot if, you know, you were talking to me today, I'm an investor, you're a startup. What do you think is a red flag I could pick up on if I was trying to build a company and I had a product? You know, any ideas of what a potential red flag could be? Yeah, I think up here. Yes, I think that's very important. I think usually when we present to our investment committee, if we're not able to explain kind of the product in one sentence, they're already saying, nah, we're not going to do it. Yeah, so I think there was a hand raised back there. Yeah. Sorry? Exactly, yeah. So if you are just building, you're not talking to anyone, you're not getting feedback from the market, you're not open to feedback at all, I think that would be, thank you, that would definitely be a red flag. Okay, so let's go through the first one here. If technology and innovation would work, yeah. Okay, so I think that was maybe one thing that was mentioned back there is slow execution and growth could be a red flag for an investor. So if I've seen you establish your company back in 2020, you still don't have a product, you haven't spoken to any customers, you haven't signed any pilots, you don't, you haven't really made much progress, that shows me that maybe the team doesn't have the execution ability to make a great company that's going to make a great return for the fund. So that could be one red flag. Now, there are caveats to this. I think one thing that I didn't say in the previous slide was that, red flags are very context dependent. So a red flag for one company might not be a red flag for another. If, for example, I am if I'm a health tech company and I don't have my first customer within 2 years, that's actually okay, because there's probably lots of regulatory processes that you needed to go to. You probably needed to go through a lot more licensing and building that deep tech knowledge and industry-specific knowledge, rather than an e-commerce solution, for example. If you don't have traction as an e-commerce solution within the first 2 years, I'd be more concerned. Yeah. Sorry? Yeah, exactly. If you're building a very deep tech company, then essentially I wouldn't be very worried. But slow execution and growth is definitely a red flag. Okay, the second one is an outsourced tech team. Now, again, very context dependent. If you are, two founders and you have a technical background, I'd be confused as to why you have outsourced your tech team. If you don't have the technical expertise in-house and you're outsourcing for a couple of months or maybe the first year or something like that, and you have all the right contracts in place to actually be able to own that technology, then that's okay. But this is sometimes an indication of a red flag for us. Another one would be low product defensibility or entry barrier. Can anyone maybe explain this one to me? Does anybody know what this means? Yeah.
It's too easy for competition to enter and you don't have any IP.
Exactly. So if you are building something that someone else could build tomorrow using a no-code platform, well, there's no defensibility and essentially you won't be able to get the market share you need for it to be an investable product. And so this is another red flag for investors when they're looking at startup solutions. And then funding for burn. So funding for burn is a red flag for some investors, but it's not a red flag for other investors. It really depends on what type of investor you are. At Plug and Play, we like to fund for growth. So this means that we like to fund you when you're looking for new hires, when you're looking to do more marketing, when you're really pushing to grow the company. If you're a later stage company and you're really just trying to maintain or increase sales and an investor wants to come in at this opportune time to actually get more equity and they don't mind funding for burn, that's up to them. But some investors will only fund for growth and not for burn. And burn is basically the cash that you're spending every day on operational activities in the venture. All right, so what are some red flags that we look for in terms of B2B metrics? So high churn of customers. If your customers, this usually is more related to, let's say, a subscription-based platform or contracts that you're signing. But essentially, if you're losing your customers and you're losing 50% of them every other month, that is a concern for us. I think that's pretty self-explanatory. Okay, if your customer acquisition cost is also higher than the lifetime value, basically you're losing too much money for us. So I think that one's also very self-explanatory. But I think, when you present these figures, I think it's okay for your CAC to be larger than your LTV if you have a plan to actually grow either the lifetime value or if you have a plan to reduce that customer acquisition cost. So another thing when we're talking about red flags is the way in which you frame it and the way in which you explain to the investor, and it's all about being transparent. If you've said to them, actually, our CAC is quite low and the lifetime value is very high, and then they look into your books and they actually find that that's not true, that is way worse than you just being upfront and saying, okay, this is what it is today, these are the numbers, but here is our plan to actually grow the value of the customers or to reduce the customer acquisition cost, and these are XYZ steps that we're going to take. Here is another very context-dependent red flag. So I mentioned before that we're a venture capital firm that likes to invest in B2B SaaS. So that's mostly software. We don't really like hardware that much just because it's a little bit more risky. You have to invest more in building a physical product, and there's less agility in being able to pivot your solution. So we don't like it if you're too hardware dependent, but that's just us. You might have better luck looking at another VC firm. And the last one for the B2B metrics is if your sales cycle is more than 24 months. I think we can all agree that if you're not able to get that customer after 24 months, you really haven't found that product market fit, and maybe you should be speaking more to the customers and really finding out what they're looking for in terms of a solution. Do we have any questions on this slide, anything that we've kind of covered here? Yeah, so I think what we would be talking about there is, what is the total addressable market for you? Definitely, I think we'll actually reach a slide. I don't know if it's the next one. Nope, it will be the one after, but we'll talk about target addressable market. But we all also have to understand that we're speaking about VC specifically. Venture capital is a very specific type of investment. And you can get investment in other ways. You're able to get money in different ways. If you are applying for a loan, for example, they're not going to be looking at the same metrics that we are. It's not going to be the same red flags at all. But if we look at the team in a recently founded startup, being a single founder is sometimes a red flag for us. And that's just because, if you're one person, there's a very big chance that tomorrow you could change your mind and decide actually you don't want to work on this project anymore. It's too difficult, and you're going to make the decision to, do either pivot entirely without diversity of thought that we need, or you might just decide to give up. And so it is very risky to invest in a single founder. We do like to see diverse teams get together, someone with a different background, being able to bounce ideas off of each other. And so that's why a single founder is a red flag for us. Again, I will say this, red flags are not red lights. So it's not like it's a definite no. Still approach us, still approach other VCs. But, that is one thing that we will consider.
Yeah, the first red flag you have on the top left on high churn. So you said if the customers drop, then how do you find out if it's legitimate, especially in these days and age where a lot of data is made up? So how can you do your due diligence in terms of the customer, the number of customers that the idea has?
So you're saying you can, as a founder, you'll make up the numbers to say that, maybe you've been able to retain 100% of your customers.
How do you identify, for example, you're saying 50% of it dropping, right? Would not show value from a VC perspective.
Exactly.
Right. So my question is, how do you, when you do the valuation, what time period is it in, and how do you do your due diligence to see if it's legitimate?
Yeah, so let's say you have, 10 customers in January. At December, these same 10 customers, are they still there? And these are actually numbers that the startups will give us. And we rely on that trust. So it really is a, trust building exercise as well. But, at certain points, auditors will come in as well, and they'll be looking at your books in detail. So, that's... So at early stage, Plug and Play doesn't lead rounds, and we don't do that kind of due diligence, but we would rely on basically a lead investor to be able to do that. Yeah. Okay, so back to team. But there have definitely been cases, yeah.
Yeah, I'm just saying that I want to say that all metrics tend to tie together. The other metrics, so for instance, if your churn is high, you see there's a cash flow problem in the business. Or, your revenue numbers are not growing as fast. So when you think about Netflix, if you had your Netflix subscription 5 years back, you're probably still at losing money. And you use it for them now. If that's the kind of business you have, your revenue keeps taking off month after month. The growth rate just keeps galloping.
So that's a subscription model, right? That you get
Yeah,
whereas some B2Bs are not subscription driven.
Well, I think the churn.
Let's say you're a B2B business and you have a contract. It's usually like a 1-year contract, a 2-year contract. We count not renewing as churn. So if you had a customer for, they signed a 6-month contract and then decided not to renew, that would actually count as them churning. Yeah. So yeah. I think another interesting point to raise is, some founders have, fabricated data, and they end up in hot water. So that is something else to consider. So another important thing that we look at is obviously your cap table, and how you are actually splitting equity within the team, within your co-founders, and also with your investors. So ideally what we're looking for, if you have, a co-founder, is that you're equally splitting equity between you, because, basically we want to see you all have equal skin in the game, and that you're all equally committed to this company, and you're all going to be equally rewarded at the end of the day as well. So we notice that when there is an equal split of equity for founders, that sometimes issues might arise. Someone's not pulling their weight, or someone is, there's tension within the team. A lot of times when startups fail, it's actually because the team in a team dynamics is the reason why. So that's why equity split is very important to us. Another one is not having a complementary team. So if you are all tech bros, that's probably maybe a little bit of a red flag for us, because if no one has any sales experience, how are you going to grow? How are you meant to get the customers? But vice versa, if you are all salespeople and you don't have a tech team, who's actually building the product, and who's making sure that it's a working product that actually meets the needs of the customers? So that's why we want to see a diverse and complementary team with the skill sets that we want. The next one is lack of expertise in tech or the industry. So if you are, you have a fintech background, you've been in banking for the last 20 years, and suddenly, you realize you have health issues, and so you'd like to build, maybe a health solution, a health tech solution, that's completely fine. that's completely fine. Even though you're lacking the industry experience, maybe you can onboard a co-founder that actually complements your skill set. But there needs to be someone on the team who's able to address, the hard questions, who understands the market, who understands the industry. And yeah, that is why you need the expertise in your team, and that's why it's a red flag for us if you don't have it. The other thing is full-time commitment. Now, I know a lot of people actually start their startups, on the side. Maybe you have a full-time job and you've had this amazing light bulb moment. That's fine. We just need to see that you have a plan to become full-time. Is it when you hit your first customer? Is that when you sign your first contract? Is that when you're going to quit your full-time job and actually dedicate 100% of your time to this startup? The reason why we want to see this is because we want you to essentially be a billion-dollar company, right? And it's probably not going to be a billion-dollar company if you're not committing to it full-time. And that goes for the rest of the team as well. So, you might have obviously a few part-timers, but at least the founding team should be completely full-time when you're, 1 year, 2 years into building the company. And the last one for team is couples. Now, this is an interesting and controversial one. But we have, obviously, if you're spending a lot of time with your partner, you might come up with interesting ideas together. And you might be a great couple, but it doesn't make you great business partners sometimes. That's not to say that it could happen. You could also be great business partners as well, but be aware that sometimes this can be a red flag for us. And so, we will ask you, how long have you been together? And are you sure you're not going to break up in 2 months and not continue with this venture anymore? So that's very important to us. Any questions? Yeah.
The first and the last point, they're very contradictory to each other.
Give me 1 second. Okay.
A single founder and then the couple of brothers, it's totally contrasting.
No, I think they actually complement each other. So we don't like single founders.
But then couples also, it's a red flag.
So couples who are in a romantic relationship together. Yeah.
So if they ask of the involved investment is to, instead of putting into the company, they ask for the selling of the old shares. Would that be a red flag? The existing shareholders' shares. Would that be a red flag?
No, there are actually investors out there who will, look out specifically for secondaries, which is what you're talking about. There are definitely investors out there who do that. We don't really do that. So we will only participate in new funding rounds. Yeah, it's not necessarily a red flag at all. Exactly, yeah. Okay, so... Yeah. Yeah. Yeah, so again, bringing it back to our very first slide, which is, these are red flags. These aren't stop signs at all. If you're a single founder who's obviously very passionate about the business, you've already been in the industry for 20, 30 years, you've really thought deeply about this problem and this market, and you're able to sell it to the VC. I don't think it's a problem if you're a single founder, but it is just something that we will be aware of. We will suggest maybe, why don't you bring on a co-founder who has technical expertise, who has growth expertise, just someone else to balance the decision making. Yeah, so now we'll move on to the cap table and kind of what we would be expecting to see at different stages. So if you are, let's say, for example, raising your seed round, and the founders have less than 25% of the company, that would be a red flag for us. Because if you are already giving away, more than 80% of your company in the first round, well, then you really don't have the incentive to keep moving forward, and also your investors will be super diluted. You'll be super diluted as the entrepreneur by the time you even raise, let's say, your Series A, which is not what we want to see. So these are kind of, the suggested cap table splits, if you will, at each of these stages. And yeah, again, these are suggested. We've definitely invested at the pre-seed stage when the founders have, diluted and they only have 65% of their company. But it will be a case-by-case basis. We'll also hear out your side of the story, like what happened? Did you have a family and friends round really early and kind of dilute a little bit more? And by the way, you can also restructure and change your cap table before you go out and raise a round. So if you find yourself really deviating a lot from whatever stage and suggested split you have, then maybe talk to your existing investors and restructure that cap table. Yes. So I think there was a question about target addressable market. So when we're looking at founders and the problems that they're trying to solve, we really do want to have a total addressable market of more than $1 billion. Just because venture capital firms are making to make a return, a financial return, right? And so we also know that it's a really risky space to invest in. We know that probably 80 to 90% of the startups we invest in are going to fail. So the ones that make it, we really want you to be that $1 billion company to basically make a return on the fund. Yeah, exactly. And that is also why a lot of investors would want you to have a plan to be a global company, just because it automatically means that your addressable market is larger. Okay. Before we get on to the next stage, do we have any questions on any of that? What VCs are looking out for and what you should not be doing or what you should be doing? Yes.
In the strategic decision making in the startup. Basically, if you have a single founder, it might be a person who's not willing to listen. There will be a difficulty to have proper diversity. It may be a person who has 500 years of experience. There's a beautiful little saying, in times of rapid change, past experience might be a worst enemy. So, what's your view in regard to the personality of the founder? And what's your engagement?
Yeah, so this is, I guess, one of the red flags I could have put out there is actually being closed-minded. So if the founder is not open to feedback, if they're not open to different ways of thinking, if they're not open to pivoting, if they're super attached to their one idea before they've done their market research, that is a red flag for us. And so the reverse of that is we're looking for a founder who's, knows what they're talking about from a technical perspective, from a market perspective, but is also open to the idea of change and is not super attached to this one idea that may or may not work, and that's open to pivoting. Yes?
I think another sign of a single founder may be that you could not convince anyone else to be attracted to that project. So that's also a red flag.
Exactly, yeah. Exactly. If you are able to get a good team around you, if you're able to convince, basically your first customers are going to be your co-founders. If you can convince your buddy that this is a great idea, you should quit your job, come with me full time and build out this venture, then I think you've already done a really great job. Yeah.
How best to present this information? Do you like kind of out-of-the-box kind of presentations, or do you prefer something that's in the normal kind of PowerPoint?
Yeah, so I would say that venture capital firms usually are, the first thing they'll say is, "Where's your deck? Send me your deck." You'll hear that a lot. So just a presentation with all of the elements, and I think you can find a lot of them online, is, what problem are you trying to solve? What's the solution? What's the market you're addressing? What have you already achieved? So your traction. But yeah, honestly, a standard deck is the way to go. Yeah.
So, do you look at the people? Like, when you look at the people, it's fun. Let's say you have a fantastic idea, business model, everything is fantastic. But the leadership, maybe you, like, for example, like Steve Jobs, and he might not be a very good leader. But will you look at that as or maybe like the co-founders, they don't get along? Would that be a red flag? And secondly, if that's a red flag, how do you know sometimes you never know that?
Yeah, so that's why we have, multiple calls with founders before we make an investment, and, we go through rounds of due diligence, and to really understand, what is the relationship of the founders. Obviously, if you're founders that aren't getting along and you're literally arguing in front of us, and not in a constructive way. Obviously, everyone will debate, and that's very healthy. But if obviously we're seeing that in front of us, then yeah, that is definitely a red flag for us. Yeah. Sorry, last question before we have to move on. Yeah.
How important is monetization for you when you're investing in seeds?
Yeah, so this really depends, obviously, on kind of the stage where you're at. So if you are 2 years in, you have a product, we would expect you to start monetizing, to have started monetizing, bare minimum. Let's say you're at the idea stage, and that's fine. We'll just put in a smaller check. Like, it's a conversation, and everything is very context dependent. So specifically for Plug and Play, though, we do want to see, a little bit of traction, whether that's, signing one contract or having your first 10 customers. Yeah, but again, we have invested at the idea stage before monetization as well. So we're now going to talk a little bit about what you should consider when you're talking to a VC. You've got your first couple of meetings with investors. What should you be on the lookout for? Not every investor is a great investor. And so you should be aware of these things. Okay, I think this is going to be an interesting one for some people, but essentially, venture capital firms have to go out and raise money themselves. It's usually not, going to be a firm that just magically has money. They usually go out and speak to family offices. They'll go speak to maybe, a corporate. They have their own institutional investors. They, gather maybe a group of 5 to 10 investors, and they'll all put in $1 million, and there you go. You have a $5 to $10 million fund. And then they go out and deploy that fund into startups. So it's interesting to think about, the investor actually has their own investors. But sometimes you'll be speaking to a firm, and, they are actually only 20% committed for the fund that they're trying to raise. They're trying to raise a $5 million fund. They don't really have that $5 million in the bank yet. So they actually aren't able to put a check into your company. So that could be a red flag. But it really depends on the stage that you're at. If you're just talking to the investors to kind of understand what they're looking for, understand if they're the right fit for you, and you're not ready to receive a check yet, and they don't have the funds yet, that's completely fine. Have that conversation, build that relationship. It'll serve you well in the long run. But if if your runway is 6 months and they're not going to be able to close that fund in the next 6 months, then you're probably not speaking to the right person, and you should put that conversation on hold and say, hey, look, we'll speak to you guys again when you have the funds. But they will probably also say to you, we'll speak to you again when we have the funds. So that is the first one. Do we have any questions on that one? No? Okay. So at Plug and Play, I think we had a slide on it, but it was 187, I think, in 2023. 87, yeah. So, yeah, but it really depends on the fund that you're speaking to and what stage they're deploying at. Okay, the second one would be you have an incompatible thesis. So if you are, a seed stage company, but you've actually accidentally got a meeting with a $500 million fund that is only deploying in Series B and above, have that conversation. Again, you should always keep good relationships, but it's probably way too early for them. And they'll probably tell you that, and you have to also probably say, let's wait and see. I think one thing that I will put in here is it's always good to add investors to your investor updates mailing list, exactly for this reason. So if you, met them at a networking event and they're on your updates, and they invest only at Series B, well, when you hit Series B, you've totally forgotten about them because it was 4 or 5 years ago, but you've automatically put them in your mailing list, and so they find out about you again, and they'll reach out and say, hey, we're actually, compatible now, and we can have a look at it. Another one would be, for example, industry-specific investors. So if there are lots of industry-specific funds these days. There's going to be an AI fund, a climate tech fund, a fintech fund. But if you are not in the right industry, speak to the right person, essentially. Do your own due diligence. Look up the firm beforehand before you speak to them. Yes, money is money, but you have to be taking on strategic and valuable money for you. The other one is, so you get onto a call with an investor, and they're listening to you pitch, and all they can think about is who else is in this round? Who else is looking at this? How much? You're trying to raise $1 million. Who else is putting in a ticket? And they don't ask you any questions about the product or the problem space. That's definitely a red flag. So usually a lot of times VCs, I think FOMO is a big thing in the VC world, in the sense that everyone wants to get in on the hottest deals, but really you should have someone that understands the problem that you're trying to solve and the product as well. I think we were having a conversation before. It's okay if they don't know everything about that specific problem, because obviously you're the one who's done all the research, spoken to all of the customers, but they should at least be asking the right questions. And they should be, asking thoughtful questions as well. So essentially, especially if you're quite an early stage startups, you want, an investor that's also willing to put in the time and the advisory and the mentoring and the coaching. And so if they have no interest in your problem, the product, they're not going to be the right person to help you sell. They're not going to be the right person to help you grow. Yeah, but it's a balance, right? If you are going to run out of cash in, 3 months, 4 months, maybe you have to make certain decisions, which is why it's a red flag and not a stop sign. Okay, so I think this one ties in pretty well to the last one, but if they don't have any clue what you're talking about, then they probably also won't have an interest in the problem and the product. Definitely, I think, if you compare these red flags to the red flags before for founders, you'll find a lot of similarities. So the next one would be that there's no commitment. If, what we were talking about before, if they're only just going to give you the money and they're going to be a passive investor, maybe that's not the kind of investor that you want on your cap table. You kind of want someone who's willing to support you with their time and effort and expertise, and so that's why we want more commitment. And then the last one is unreasonable terms. Let's say you're trying to raise some money. The investor comes in, they're like, yes, we'll give you all of the funds that you're looking for, but they said they want 70% of your company. That's probably not a great idea, unless they're coming on as a co-founder maybe. But usually an investor isn't going to be able to commit enough time and effort to be worth 70% of your company. So just be aware that it's not outrageous terms, and maybe speak to your team, speak to other founders, and figure out, is this actually a good deal for me, or is this a reasonable deal for me? And that is where the art of negotiation comes in. Any questions on any of these? Okay, well, that is the end of the session, but we can do some general Q&A now. I think we have 1 minute. Are there any questions that we haven't addressed? Yes. An NDA, yes. So a non-disclosure agreement is something that I've been asked many times to sign. As a company policy, no one at Plug and Play signs an NDA with a startup. And that's just because, having invested in 2,000 startups, we've probably spoken to more than 20,000 startups, And so if you have an NDA with all of those companies, how are you even meant to keep track of that? And so a lot of VC firms, actually I would say 99% of VC firms will not sign an NDA, just because you're speaking to so many startups. And really, the things that you're presenting as part of your pitch shouldn't really need an NDA either. If you are disclosing, line by line your code or, the whatever it might be, that's probably something that you're not meant to be doing. So yeah, NDAs is not something that we sign with startups that we're looking at for investment, and a lot of VCs won't.
And you mentioned you have 50 offices worldwide. So if it's a global app by an American, would that individual, would it be better to contact the US office? Or what if they're Dubai-based, but from the US?
Yeah, so I guess this question is, who should you reach out to at Plug and Play, specifically if you are looking for investment? Probably contacting, whoever is closest to you regionally would be correct. But for example, when, we had the discussion, we're ready to make the investment, and turns out you're incorporated in Delaware, but you've been speaking to the Abu Dhabi office, and we would basically just refer you to the US legal team. So that's the only difference there. But there's, anyone at Plug and Play can connect you to the right person. Yes.
So my question is about exclusivity. As you mentioned, the VC, sometimes they don't have the fund, they have to reach out to the family office and other investors, so they need time. And they ask the founders to be exclusive, and sometimes 1 month, 5 months.
With that individual, would it be better to contact the US office? Or what if they're Dubai-based, but from the US?
Yeah, so I don't think there's usually exclusivity agreements with investing in a startup. That's what you're...
1 month, 5 months. And what is the rule of thumb? And you never do that, right? And what is the rule of thumb of this kind of exclusivity?
Yeah, so usually... Yeah, I mean, if that's the right investor for you, and you know them quite well, you have a great relationship, there's usually no exclusivity agreement that I have seen, at least for the rounds that we've participated in. There's no physical contract, but a round might be very competitive, and a lot of top-tier VCs might want to participate, but you're only trying to raise $5 million, but you have enough commitments for 10 million, then you have to be more selective, and that's up to you at the end of the day who you want to let into the round. You don't have to take just anyone's money. Yeah. So, yes.
So I just wanted to know, how do you know that you are ready to approach VCs or angel investors or whatever? What stage of your business should you be at to approach VCs?
Yeah, so you have to ask yourself the question of, do I need the money? because I think that's really like the most interesting question. Yeah, so, you know, you want to be taking money either because you're running out of money or because you have plans to grow the business. So those are I think the two scenarios where you want to take on money. And if you need to take on money, then that's what the stage that you need to be approaching VCs. But it's always a good idea to be speaking to investors, to be telling them what you're doing, what stage you're at, so that you keep that relationship going. Because at the end of the day, I think we already know it's a lot about trust and building that trust. And the more transparent you are, the better relationship you have, and therefore, you know, when you're ready to take on money and to grow the team, then they'll be there. Yeah. Yes. Any other final questions? Yes.
Perspective and impression. So perspective, just in terms of having raised funding in the past. These for me the best type of investors were people who would give you money and then leave you alone. All right, just people who would give you money and then just leave you alone because they had enough trust in you to know that you know what you're doing. I'm just going to give you the money, go do your thing. And these kind of people generally were ex-founders themselves, right? Who kind of knew product, who kind of knew what you were doing, and had enough trust to come and invest in you. On the other hand, I do see the value of people who can actually add, some additional value to the company. Out of the 180 companies that you've invested in, where do you think you've added in the most additional value, and then what value was it?
So the question is, what company have we invested in where we've provided value?
Yeah, just out of the 180 companies, where do you feel like if there's this one particular company or so many of them where you felt like you've added in tremendous additional value?
Yeah, so I mean, Plug and Play generally, because of the programs that we run, because of the corporate kind of consulting and network that we have, that's actually why we like to invest in B2B companies, because the same customers that they're targeting are also our customers. And so we're able to make that direct referral and say, you know what, we're actually going to introduce you to your next client because they've come to us and they said, you know, this is the technology that we're missing, and we say, great, we have this portfolio company, or we have this company that we've accelerated, and they are building exactly what you need, and that's where we come in. And so from that point of view, we actually are quite passive. You were talking about passive investors before, the ones who kind of give you the check and they have enough trust in you to know that you're doing the right thing. We kind of do that, and we also are the ones who are going out there and being like, oh, by the way, there is this corporate out there who's looking for a solution that you can provide. And that is where we come in and bring that value, is being that connector between, you know, the startups in our ecosystem and the corporate and government entities that we work with. Yeah. Yes.
About the AI industry, what have you seen as the investor sentiment and how it's evolved at this current moment?
Yeah, I think is that a red flag? Or are we still on the same topic? I feel like I'm being interviewed on a talk show here, but no. I mean, for AI companies in general, obviously, everyone is talking about AI now, especially Gen AI. But in general, I think, you know, VCs have been hearing about AI for the past 20, 30 years, honestly. So yes, we're excited about, you know, where we are today about AI, but it's not just like if you plaster the word AI onto your slides, we're going to be like, yes, here's the check. So I think the sentiment is that super excited, but we have to do a lot more due diligence in the sense that, you know, yes, everyone is an AI company now, so which one is the one that's going to make it? I think that's where everyone is a little bit more cautious. Yeah.
A multi-million questions asked many times, but I want to see from Plug and Play's perspective. Like for the startup, you said you invest in the seed and A, and usually those companies don't have the benchmark. They are not profit generating. How do you make the valuation from your perspective?
Yeah, so plug and play is usually not the one who's going to be the ones giving you the valuation. It's going to be probably between you and your lead investor. Because we come in with a smaller ticket, we don't usually lead rounds, and we'll leave that discussion for you and your lead investor. Usually it actually is a proposal from the startup founder themselves, along with some negotiation with the lead investor. So everything, again, is a conversation. You can maybe work with a consulting firm and come up with a valuation, but honestly, at the early stages, that's not something that is common practice and is usually not needed. It's so usually. Yeah, so we have a good idea of the market, right? We're speaking, when we say market, we mean, the founders that are coming up with startups. We're speaking to maybe 10, 20 founders a day, and a lot of them are coming to us and saying, okay, this lead investor said, it's going to be a $10 million valuation, and then another startup says, we're at the same stage, we got a $7 million valuation. But at the end of the day, it's going to be, what percentage of the company does the lead investor want? So if you're trying to raise, a $1 million round, and they want, the lead investor says, we usually like to take a 10% stake in a company, and they're willing to put in the full $1 million, then your valuation is going to be $10 million, right? Then they have that 10 million, they have that 10% stake in your company. So it really isn't very much about the actual value of your company, because at the end of the day, if you're still not making any money, what value can you really place on our company? So it really is more about what is the percentage that the lead investor is looking for. No, you don't. But that is where we usually like to come in, is when you do have a lead investor. But yeah, it's still okay for us to invest without a lead investor, but we would want most of the round to be committed already, and for there to be an agreed on kind of valuation as well. Yeah, and if the valuation doesn't fit us, then we'll pass on the opportunity.
Startups are you all? I mean, if you were to give a percentage.
We actually did this for our GCC portfolio companies. I think we have around, it was between 15 to 20% of the companies that we've invested in the GCC have at least one female founder. Yeah. So that's kind of low. It is definitely low, yeah. But I think in terms of global average, number of female founders overall in the world compared to male founders, I think it's usually off balance, yeah.
Would that have a privilege, having a female founder, from your investment decision perspective? Would you be married and someone is female?
So, there are funds out there that will only invest in female-founded startups. So in that case, yes. It really, again, is about relationship building with your investors. So yeah, I would definitely encourage you to speak to as many people as possible and to find those advocates for you. Do we have any other questions? I think we are over time, but it was very nice to meet you all today. And thank you for coming.
Okay, so we're done. Thank you guys for attending. Thank you, of course, to Sion for leading this event. So let's all take a quick photograph in the front, if that's okay with everyone.